What matters is, does this person truly make you better? How do you save yourself and your business from a cash flow crisis? But it can also be used preemptively. That deposit is going to actually show up as a liability. You're giving such value out at such a low price, a lot of customers flock to them.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Well, welcome to the Business Coach. In this week's episode, we're going to deal with something really painfully important when it is important. It's jugular to your business. How do you save yourself and your business from a cash flow crisis? So what is a cash flow crisis? Let's just give an example for it. So earlier last year, in roughly September, I was having a conversation with one of the construction companies that our company coaches. They had gotten into a bit of trouble with some decisions that they made. And we'll go through and diagnose it, and I'll give you the model. But basically, they were at a point where cash was really, really tight. And then they had two important contracts for themselves, for building contracts, for major renovations for homes, just a little bit over roughly $2 million worth of contracts, get canceled on them. And that was really painful for them. They had to make some quick cuts for what they did staffing-wise. They had to figure out what to do for free up the cash flow. Probably took them close to 4 to 6 months to recover from that part and get back to solid footing. Now, it wasn't just the fact that it was 4 to 6 months of pain, but it was also 4 to 6 months of losing the momentum of the growth that they had before. The reality was they were fully avoidable things. And so I want to talk today about how do you save yourself and your business from a cash flow challenge. And we're going to use this based on a coaching methodology that we've developed over the years from coaching business clients. You know, again, at this point, we've coached, several thousand businesses over the years, whether they be at workshops or formally in the coaching program or other means. And what I'll tell you is, as a coach, I've learned of how to pattern a decision tree, a diagnostic tree, to first understand why the business is in cash flow challenge, get the root cause, and then what's the best pathway out of that cash flow challenge. So really, we've got to do two things here. Number one, the first and most important thing is we've got to diagnose what's actually going on, right? If we can't figure out what's causing that cash flow challenge, then the average person's way to solve it, they think, is just to sell more. But if that cash flow challenge is caused by, for example, their gross profit margin is off, so in other words, their pricing or their cost of goods sold, their pricing is too low or their cost of goods sold is too high, and they're losing money on each sale that they make, then selling more is going to only make the hole be dug deeper. On the other hand, let's say it's a collection issue. Selling more, if I haven't fixed the leak of collections as an issue, again, is going to make it worse. So there are some types of challenges from a cash flow perspective that selling more will absolutely help. But there are others that selling more will absolutely make worse and maybe even make deadly, something you can't survive from. So the first step is what's going on. We've got to diagnose what's going on so that, number two, we can put together our plan about how we get out of that cash flow challenge. So let's talk first about diagnosing what's going on. So I want to give you, where I came up with the idea for this decision tree is not my own. So I remember as a kid, my dad was a nephrologist and was a nephrologist for 33, 35 years. And so as a doctor, a physician, they used to talk about differential diagnosis. As they would say, ask a body of questions, and that would let them know, nope, it wasn't this, maybe it was this. Ask some more questions. It can't be that, so it has to be this. Go down this branch of it. And so that's what we're going to do. We're going to use this. I've taken that kind of concept of a diagnostic tree so that you can diagnose what's going on with the cash flow crisis. Now, your business might right now not have a cash flow challenge. Good. Understanding this decision diagnostic tree about what's causing a cash flow challenge can be used in a crisis, but it can also be used preemptively to keep you and your business out of that crisis by, how do I make sure I never go down any of those forks? So let's do this together here. So the first most common place for a cash flow challenge, and again, this comes from coaching of client businesses now for 27, 28 years, the first place of it is a collection issue. So how do you know if it's a collection issue? First of all, you're going to ask and look for certain clues. Clues would include things like, how long is it taking you on average to collect your receivables? Look at your aged AR report. If when you look at your aged AR report, you see that you've got a lot of money on there, if your typical business is $10 million a year, and you've got $3 million of aged receivables, that's probably a warning light going on there about that. We're also going to look about your AR that shows up on your balance sheet. Now, an aged AR report, great, you can print that up straight from QuickBooks, which most of you are probably using, or any other accounting software is going to have a way to easily pull an aged AR report. But if you're just even looking at your balance sheet, you're going to be able to see under one of your current assets, which means short-term assets, something that's going to be converted to cash typically within 12 months, you're going to see on there that you have that how much your AR is, and you should be looking at that. Quick point to be aware of, especially for those types of businesses where you collect deposits, but you haven't started the work for a period of time. For example, a construction company is a great example for this. You know, I get a $50,000 or $100,000 deposit for what I'm going to be doing. I'm ordering materials. It might take me 3 months, 4 months, 5 months for the custom materials to be done. And until the point in time I start the work, that deposit is going to actually show up as a liability customer deposit on my balance sheet. It's a weird thing, but the work hasn't started, so it's going to show up there. You got to be careful about things like that. But going back here, you're going to be looking at things like, what's your existing collection system? Like if you've never thought about how to do your collection system, and if your business doesn't collect money up front in advance of actually delivering your product or service, then I would look first at your collection practices. And I'll give an example for it. So one of the law firms that we work with, this is a law firm that we coach for a number of years. Early in that relationship with that law firm, they were doing round numbers about $1 million per year of revenue. Now, it's not uncommon in a professional services firm to be running anywhere from a 30-35% profit margin. Really well-run professional services firms, they're probably going to go ahead and run even at a higher percent off profit with that. They might have as an operating profit margin even more. This business was running at about a 30% operating profit margin, which meant of every $1 coming in, roughly 30 cents dropped to profit, which means they were making, the owner of this small law firm was making about $300,000 per year of operating profit. That's pre-tax profit that comes from the direct operation of your business. It's probably the most common, useful way of thinking about profit for most small businesses under 10 million, 20 million a year. On QuickBooks, you're going to see that show up as what's called net income. Net income is pre-tax profit, but net income actually adds some other elements of revenue that aren't directly from operations. But for most small businesses, they're one and the same. Not technically the same, but functionally or practically. So now when we looked at it, though, I remember talking to the owner of this law firm, and she was the main attorney. She had 2 other attorneys that she worked with. And her comment was, David, we don't have a receivables issue. And now I knew she had a receivables issue because I looked at her financials. And when I looked at her balance sheet and I looked at her P&Ls, I looked at her, I didn't get an aged AR report, it was on her balance sheet. What I saw was, round numbers, that she had roughly $100,000 of receivables that when I asked further questions on, turned out that these receivables were greater than 90 days due. What does that mean? She effectively has 1/3 of her profit sitting in her receivables that are over 3 months past due. That's a pretty delicate place to be on. So once we figured that out for her, we could now say, what's our way out of it? When we realized that her cash flow is tighter because of this part, why am I not seeing the $300,000 in my checking account, David? Well, here's why. Because you're missing $100,000 of it, 1/3 of that you've already paid all the expenses for, that's pure bottom line profit is sitting there and you haven't collected on it. So we changed things like, we looked at her collection system, we changed things like how much of a retainer was she going to collect up front, right? A deposit, the equivalent to deposit up front. At what point was she going to ask and request that a client replenishes the retainer versus letting them just now starting getting paying in arrears? How is she going to invoice and bill? How is she going to follow up with phone calls, letters, or her sending an email from her account saying, hey, I need you to go ahead and make a payment. You're now at, I'm going to make up a number here, you're now at $16,000 of the bill for the legal services. I need you to take care of that, please, right? Those types of things, when you clean that up, that $100,000, here's the irony. She didn't want to upset clients when I brought this up to her. Her first response is, well, David, I'm going to upset clients. When I coached her through the following fact, the longer you let it go, the less likely you are ever to collect. That's why we always say in collections, you front load the effort. It doesn't mean you get tough, it means you get more professional in that part. She was sending invoices out, typically on a monthly basis, but that means if someone came in right after she sent her monthly invoice, it might be a whole nother 30 days before they received an invoice. And then what typically happens in a business that doesn't do collections well is the client will say, when they get the invoice, they'll wait 2, 3, 4, 5, 6 weeks, you'll follow up and they say, well, hang on, give me the detail behind that. Can I see the timesheet? Can I see the supporting documents? And now what's happened is what should have been paid in 30 days now goes to 60, 90, 120 days. So we pushed her about how to front load those efforts professionally. How can you start doing your invoices at least bi-weekly, right? Every 2 weeks, if not weekly. It doesn't mean you send the same person an invoice every week or every 2 weeks, but every week or every 2 weeks you sit down, or you have your staff person sit down, and any new people in there that should be invoiced for, that you've done work for, you do a new invoice for them so they don't wait, you don't lose an extra 30 days. We started making sure that their staff was doing follow-up emails and phone calls to get payments from that part. Can you take credit cards to be that part? You know, some of the people will, and if it's a law firm or professional service practice, quite common, they'll charge an extra fee for the credit card processing, 3.5% for the convenience of that. But even if they push you on that, still collecting this money here, even if you had to say less than 3.5% for credit cards or less than 2.5% for credit card, would still be worthwhile. If you let your receivables go long enough, your clients will actually start leaving you, because you'd say, well, why would they ever leave? They're not paying. It's a weird emotional thing I see from people who are customers or clients, that if it's really that imbalanced and then you start to ask for payment, they're going to go. So if you're going to do the work, you should be professional enough about getting paid. So that's an example on the decision tree. And let's come back to the decision tree here if we can. On this decision tree, the first place that we look for as a cause is we say, is it poor collections practices? Now, again, if I receive all my money up front, before I ever have any production or cost of goods sold or cost of service directed, then it's not going to be a collections issue. I start here. So if yes, it's a collection issue, solutions say things like invoice faster, front load your collection efforts, redesign your collections process to make more sense. Pay attention. Look at your collections, your aged AR report. Look at your AR report on a weekly basis, or if you really are in a cash crisis, you should have your daily people that you need to call. Or in some cases, for example, we had one contractor we work with, he had a very high-end electrical business. We said to him, hey, you should go drive over to these people's offices and say, hey, I'll wait here while you cut a check. It's awkward, it's uncomfortable, but he was in cash crisis because he had close to $400,000 of outstanding receivables from his commercial clients. That's a much better way of going. So again, if it is a collections issue, we now know how to solve it. What if it's not a collections issue, right? What if it's a pricing issue? That's the second place we go. So if it's not collections, the second place we go is it a pricing issue? Clues that it could be a pricing issue include, we're looking at, do you have a low gross profit margin, right? We're going to look at your gross profit margin relative to what you historically have run or what your industry should run at. We're going to look at competitors, right? We're going to also look at gross profit by service line, product, or some other key breakdown in your business. Maybe it's by location, and I'll give an example for that. One of the medical practices we work with, they had 3 medical offices for their practice. And when they looked at it, they had went from making a good bit of money down to, when they opened up the 3rd office, they started losing money in that office space, so that their profit went from $800,000, $1 million a year profit down by quite a bit, down to $300,000-$400,000 of profit. When we did the analysis, that 3rd location was actually a dog. It was losing the money. And so with staffing and the rest of it, so they had a choice. They could either try to fix the 3rd location, or actually what our coaching to them was, hey, you could probably keep 70–80% of the volume from this one location at your other 2 locations, get rid of all the real estate costs, get rid of all the staffing costs from there. You'll still have the provider cost for your other parts, but you can now take that volume, spread it over here, use these 2 locations better, and lo and behold, their profitability shot back up, and it solved their cash flow challenge with that part. So pricing can be an issue from that part. Pricing is another way to look at that is if you don't look at and review your pricing, here's a way it can catch you. Most people, the way we set pricing is once upon a time when we started the company, we set our initial pricing when we launched the business. And when we launched years and years ago, we set a price of, let's say, I'm going to make up a number here, we set a pricing of $100 per hour or $100 per unit of what you're selling. But that was back when you were hungry, you probably were working out of your house, but here you are, it's 13, 14, 15 years later. 15 years later, you now have office overhead, and you have staff, and you also have a track record that says you're much, much, much better at what you did way before. You were new as an entrant to the marketplace. It made sense you priced toward the lower end of the market. But now you're not. Now you're very good at what you do. Most people price initially, and they just raise a little bit, 2, 3, 5% increases. Every little bit they'll do 2 or 3%. Versus if you look at it, the best way to price is not in relationship to your original price, but in relationship to what's the value you're establishing for the market and how competitive is that space. If you produce 1,000 units of value per hour or per unit of service that you provide, and the market, you're a market leader, so you can command that price, you shouldn't worry about what you charged 15 years ago. You should price based on the value you create in the market, adjusting that value for the market by how competitive is the space. If all your competitors are at $400 per unit of work and you're at $1,000, you better have a dominant brand position to be able to command that. And if you do, wonderful. If you don't have a dominant brand position going to that high, you're not going to be able to consistently command that prices. The market is fairly smart over time. So when it's a pricing issue, you're going to ask the question of, have we looked at our pricing anytime recently? If you priced by what you originally did and every couple of years you think, well, I'll raise it just a little bit, then probably pricing, if you have a cash flow challenge, is something you should look very significantly at. So let's say you discover it is what you're dealing with. What do? Strategies includes that we should strategically review pricing. We should go to our market space and look at what are our competitors charging. What's the cost of the problem to our customers that we solve? What's it costing them not having a solution? How hard is it for them to find somebody else to do the work? Where do we stand capacity-wise? We look at that, and that gives us a ballpark of what we can do with pricing. We should probably immediately raise pricing on all new customers to some degree. Here's another example of what this kind of looks like over time. So, and I had shared this, I believe, in an earlier podcast. I can't remember what episode. At this point, now that we're further into it, it starts to feel like I've been doing it forever. And I hope you've been enjoying the Business Coach podcast. But let's just make an example here. Let's say that you have, I'm going to make up a number here, you have 500 clients in your business. Now, if you were to do an analysis of your clients, what you probably discover, if I look at each of these clients based on what we call gross profit margin, which is total sales, revenue, let's just do our math here, revenue, total sales, less cost of goods sold, less the direct cost, that's COGS, stands for cost of goods sold, less the cost, the direct cost to produce your product or your service, right? What I'm left with is my gross profit. That gross profit as a percentage of revenue, so gross profit divided by revenue, is going to give me my gross profit margin. And what you're going to probably discover is you're going to have A, B, and C clients. Now your A clients are probably going to have great profit margins, right? You're going to have really, really good gross profit margins. Funny enough, these tend to be the clients that don't complain about their bills. They tend to pay on time. They're delights to work with. Then you're going to have B grade clients. They both have reasonable margins, but sometimes they're a little bit slower to pay or a little bit more demanding. And here's the thing. When someone's a little bit more demanding, asking for extra servicing, but you don't charge for that extra servicing. You learned about this in the Business Coach podcast earlier on in the episode about scope creep. Scope creep is like a stealth way of reducing your price. You're charging X dollars, but you're producing services for a larger amount, right? You're giving them extra services, which is reducing your pricing. It's like going to a restaurant saying, I'm going to order a steak, and I'm going to pay $48 for that steak. It's a delicious steak, and I say when I'm done, hey, I'd like another half of a steak, and they give you that half of a steak without charging you more. They've effectively reduced their price. I've gotten 1.5 steaks, not for 1.5 times the price, but for the same price. So scope creep is an issue with that part. We'll get to that when we talk about solving it. And then you're going to have probably some percentage of your clients that I'll call C bucket that are low or even break even or negative gross profit margin. And these tend to be the people that pay slowest and are most complaining and ask and demand for the most extra services or stuff, right? Scope creep. So what should you do? You know what? If I diagnose this is what's going on and a cash flow challenge with that, it means that these people are the wrong types of clients or we're charging way too little. So with these people, we're going to immediately raise pricing on these people. We're going to raise pricing. Now, if we're concerned that we have 112 of these people, I might break them in half or break them into thirds, do one in 1 month, then a month or two later do the next third and then the next third, for example, to give myself a little bit of time to execute that, absorb that, learn from the lessons from that part. Now, the first person is what they're going to say is, well, David, I'll lose these customers if I raise prices. To which I say, if they're negative margin or very low profit margin, and they're slow to pay, and they're unpleasant or demanding kinds of customers, good riddance, right? You'll free up the capacity so that you can take on more A-level clients. In your business, generally when this is an issue on pricing, it usually also accompanies a business that has too much demand and they don't have enough capacity. Why is that? Because they're giving such value out at such a low price, a lot of customers flock to them. But a lot of those customers are C bucket customers. I would rather you have some holes in your production schedule, even a little bit of a scramble to get some of these customers. Now, you don't have to do all of them at once. If you're really that scared, great. Let's take, if these each represent 1/3 of the business, I could take half of these people and do it with it, which means I'm only putting at risk 16-ish% of my business, where some of them I'm going to say to them, look, hey, if you want to stay with us, you've historically been paying, I'm going to make up a number, you've historically been paying $200 per unit of value we deliver. You know what? Our current pricing for new people coming in is $395 per unit of value. I'm going to ask that we raise you to $350. So you're still going to be 15, 16% under what new people coming in are, but we have to do that. Why? Because we're actually losing money on the contract with you. I know that wasn't your intention. We just started the pricing way back when you became a customer of ours 12 years ago, but we really haven't kept pace with the inflation in the marketplace. So our choices for you here, Mr. Customer, are either we're going to have to raise this for you here, or if you want, we can support you that you're going to go somewhere else, and we certainly would understand that. We just can't keep the business at that price. We're losing money, or we're not. We have all these people we're turning away at the $395 per unit of value, and right now you're paying half that, and it just doesn't work for us. We need to make that change, and so right here we are. It's March 1st, and we'll start that on March 15th going forward. That's what it's going to be, right? So you can be intelligent with that part of it for raising pricing. We talk about this as the 3 bucket for your legacy clients, is what I've just described right there, the 3 bucket for your and be careful about controlling scope creep. Now, remember, I already went through in an earlier podcast. Do you remember that one about scope creep and how to defend yourself from scope creep? If you haven't listened to that, go back and look through the shows for the episode about how to defend yourself from scope creep. One of the most kind of stealth ways that you get into a cash flow issue that's caused by pricing is in fact by scope creep. So we can either raise prices on them explicitly. Hey, we're going to go from $200 per unit of value to $350 per unit of value, or we can reduce the scope of product delivered or the scope of services delivered. So if we used to give this much value and we charged $200 for that, and I need to do a fairly significant increase, I can simply say, okay, from now on we're going to be only doing half those services, and you can still pay the same $200. Right? That's another way of raising prices indirectly by reducing the scope of product or services delivered. Both will work. Now, what will happen when you do this series of price increases, if you have 100 people that you have a price increase with, probably you're going to find out that somewhere between 30 and 70 of them are going to say, fine, I'll go ahead and take the new prices, grumble, grumble, grumble. And probably half of them will stay long term, and half of them will later on filter away to other people. Which means that you'll keep at least 25% of the C bucket stuff, but you'll have made them into an A bucket customer based on pricing, or at least a B bucket customer. And you'll keep another 25-ish% of them for anywhere from 6 to 24 months before they find some other place to go. Many of the people who leave you will later on, 1-2 years later, come back to you when they discover that in the marketplace, you are still a great option for them. Of the people who leave you initially, you know what? You'll now have freed up the energy to go find. You won't be so busy scrambling to produce. You'll actually have freed up the energy to bring in better customers. It's painful and it's scary, but it almost always is a good decision. So the first place you're going to look is this cash flow caused by collection? Second place we're going to look, is it a pricing issue? Third place we're going to look is this a sales volume issue? Is it a sales volume issue? Sales volume, if you look at your current sales volume relative to what your overhead is, relative to what your costs are, that's one clue. You can look at your gross profit margin. If your gross profit margin is off, you don't feel it's pricing, but you feel it's your efficiency in producing because you haven't hit a certain volume threshold. That if you could, for example, here's a very common way this shows up. Let's say you've got a magic widget, a production widget, this magic thing that you can now use to produce your part. Now, by the way, this widget might be a piece of equipment. It might be a certain staff type of staff person, or a certain type of role, a technician or a consultant or a provider, depending what type of business it is. This might be a physical location, space, for example. So, for example, how might this work? Let's just look at it. You have this production widget, and let's say you're utilizing 60% of it. So you might have all the cost, 100% of the cost, but you're only utilizing 60% of its capacity. So for you, it might be a sales volume issue that if I can get myself from that 60% utilization to 80%, 100% utilization, same overhead of cost of that widget, now I can be more profitable. So let's give some examples for what that looks like. I know I just used kind of some strange languaging, widgets and widgets and wizards and lions and tigers and bears, oh my. But what do I mean by that? So let's imagine that this is, you've got, in your business, you have a service firm, and you've got a field team of, I'm going to make up a number here, of 24 field technicians. Now, if those 24 field technicians are only 60% full, but you have all the labor cost of those 24 field technicians, it's going to cause a cash flow challenge, right? You probably don't have any profitability left over. Matter of fact, you might even be negative. So a couple ways to solve that. One might be we reduce the number of magic widgets that we have. We go from 24 field technicians down to 20 or 16 field technicians, so that automatically that 60% utilization goes up to 90 or 100%. That's one way to go. Reduce the number of widgets that you have, these magic things, right? Could be staff, could be locations, like the example I gave you earlier of that medical practice that had 3 locations. When they went down to 2 locations, those 2 locations instantly became more profitable relative to their volume. Most businesses where I think that the demand is out there for your product or service, I don't know if I like by shrinking my widgets. I will sometimes if I'm 60% utilized and I don't think I can get to 80, 90, 100% fast enough, then I will shrink the number of widgets I have, the number of key people I have, the number of locations or overhead that way, or even the machinery that I have. I can do that by subleasing it out to somebody else, or I can literally let it go, downsize it or something. If I think that within a period of time that I can afford, I'll get it back up to speed, I focus in on how do I increase sales volume very quickly. Now, I'm not going to increase sales volume very quickly in 30 days. It might take me 60, 90, 120 days to really start seeing some momentum with that, depending what it is. So I have to be careful. If I know that that cash flow challenge is because of my sales volume relative to my current cost of goods sold, and a lot of that cost of goods sold is not variable, but it's fixed, and I think that that's going to happen for a while, I should be cutting down on my production widgets. I need to cut costs from that part. If I think that my production costs are variable, like I only pay staff when I have work for them to do, then that's not an issue. Make sense? Good. Then in addition to this part, if I think I'm going to be able to ride through and get my 60% utilization of my production capacity, my widgets there, so to speak, up to 85, 90, 95, 100%, and do that in a time period that I can afford to do it, and I have a high degree of confidence, then I don't mind taking that curve. So for example, if I have a medical practice, to recruit a mid-level provider, a PA, physician assistant, or a nurse practitioner, or a doctor is incredibly difficult to do in the world. It's very competitive. We know that as consumers because it takes us weeks and weeks and weeks to get a scheduled appointment with our GI doc or with our dermatologist. That said, if I've got some good people there and I believe that over 6 months or 12 months they're going to be filled up, and I believe I can handle the cash flow cost or burden as we ramp that up, then I'm willing to do that. If it's easy to get widgets later, I would prefer to get rid of some of my widgets now, cut my costs such that my utilization by cutting X number of widgets immediately goes to 90 or 100%, and I can easily add widget capacity later on. Wonderful. You know, if my widgets truly are adding more server space from Amazon Web Services or something, then that's a better way to go. So another clue that it might be a sales volume issue, and this is one that I'll share a painful experience for me about where I did it wrong, and I want you to do it better, would come with the case where you have a recent dip in actual sales volume. So this is another example for it. So imagine you have a business and you were doing about $1 million per month of business, and then all of a sudden you had a dip and it went down to $600,000. And that dip, you now have all the expenses of overhead and staffing as if you were producing for a $1 million a month volume business, product or service, doesn't matter. And now you've had a reduction of 40% in sales. So that can cause a cash flow challenge in many cases. If that's what's going on, I have to ask myself, how reversible is that cash flow challenge? How replaceable are the production part of that cash flow piece? So I'll give an example. A business that I sold, I guess I would have sold it in 2005. Wow, so I'm getting old, man. 20 years ago I sold the company. But before I sold it, we were at a payroll of round numbers of about 250-ish thousand, 300,000 a month of staff cost. I think it was about 250,000 of staff costs. It's been a while. And we were staffed up to handle round numbers of about $10 million a year of business. Volume dropped by about 30%. We could have cut probably anywhere from $90,000 to $100,000 of payroll fairly painlessly, other than the human cost. And we felt like, well, we've got this great team and we're going to go ahead and keep them together. 6 months later, after having 6 months of paying $100,000 too much in our payroll, $600,000, we finally started making the first round of cuts because the sales volume did not magically go back up like we thought it would be. So if you are going to have to make cuts, make them early and get them done. Don't make them little bits over time. Don't delay them too hard. You got to be careful about that. So let's say it's a sales volume issue. What are your solutions? You know, what's the real sales issue? Is it conversion? Is it the type of leads that you have? Let's solve the real sales issue. Do a sweet spot analysis, right? Look at what are the ways that we could improve sales. How do we solve this challenge? Put it through the filters, and we talk about with coaching clients, low-hanging fruit. Which one of these are low-hanging fruit, easy to do? Which one of these are home runs that if I fix it, it's going to have a very big impact with that part? And look for the ones that are both low-hanging and home runs. Make sure that you're putting enough talent on that, right? You as a business person might find an area of the business like working with a particular client or innovating on a new product or service, really exciting for you. But if it's a sales challenge and you're one of the best sales talents You need to put some energy and attention there. And then finally, here's a strategic principle. We call it feed your winners, starve your losers. Almost always in a sales function, whether it be your salespeople, you're going to have, let's say you have 5 salespeople, you're going to have 1 or 2 stellar standouts, and you're going to have 1 or 2 sales dogs. What happens is many companies don't even think about it. They have leads come in, 100 leads come in, and they get divided 20, 20, 20, 20, 20 across your 5 salespeople. But if your top salesperson can handle 30 leads, and they are 3 times better at selling than your bottom producer, then you should give your very top person 30 leads, and the next person you should probably give 30 leads, and the next person you might give 20, 25 leads, and the next person you're going to give 20 leads, and you're going to basically let your bottom producing salesperson go probably, because you'll make much more money. I've seen this be the case that the top selling salesperson closes at a 30% close rate, the bottom producer closes at 10%. So for every lead you give to the bottom producer, you're giving up 3x the amount of revenue for a top producer in terms of just closing rate, let alone average unit of sale or average ticket of sale. So let's be smart about that. Feed your winners, starve your losers. How about marketing tactics? We had one client that was spending well over $100,000 on pay-per-click that was producing 0. Matter of fact, the business it was producing was costing it money. They cut that out, their profit went up by $100,000 per year, right? It helped with the cash flow. Even better, they reinvested half of that into a marketing tactic that was producing from them. They grew sales by $2 million over 2 years, took their $5 million company to a $7 million company. It really can be effective. So if in fact it is a sales volume issue, solve that. Now, let's say it's not a sales volume issue. Let's say that it's something about, the next place I look is if it's not sales volume, right? If it's not pricing, and if it's not collections, pricing, sales volume, now I look at expenses. Notice expenses is where everyone wants to go first, but almost always it's the 4th culprit in a cash flow challenge. So now I'm going to get deeply into my P&L statement, my detailed P&L. I'm going to honestly look at expenses. I'm going to honestly look at staff and their use of time. I'm going to honestly look at my own time in here. And based on those things, I'm going to discover that yes, it is me controlling expenses poorly that got us into this challenge. And so to get out of that, I'm going to have to be much smarter about my strategic versus my non-strategic expenses. My strategic expenses are those expenses wherein I put in $1 and they generate $5 or $10 back, right? I get ROI on my strategic expenses. My non-strategic expenses, I put in $1 and I get less than $1 back in value. Non-strategic expenses include pet projects that we shouldn't do. Working for poor margin customers is another example of non-strategic time. Having your best people solving or working on some low value stuff, example of non-strategic time. You doing your thinking about which product lines or service lines you should or should not carry, what types of customers you should and should not work with, what types of people you should or should not hire, that's really high value time. That's strategic time, right? So let's say that it is the issue. What do we do about it? So if it is an issue about controlling expenses, well, we should look at cutting what we call the non-performing. That would be example of pay-per-click for the example I gave you. By the way, I'm not knocking pay-per-click. It's worked really well for other clients of ours. But these non-strategic expenses, don't cut slowly, cut them immediately, right? Wasteful projects, wasteful initiatives, cut them immediately. Double down on your winners. Double down. Take the saved resources or a portion of them and invest them intelligently on your winners. And then take an honest look at your staff. This is a painful one. If you've got people, too many people, or you've got people who really aren't producing, but you just haven't wanted to deal with it, this is the time in a cash flow challenge that you're going to have to just deal with it. I know it's painful. So those are the main 4. There are another 3 that I'll cover very, very quickly here for other potential cash flow culprits. Again, start with, is it a collections issue? If it is, solve it. If it's not, go on, is it a pricing issue? If it is, solve it. If it's not, go on to, is it a sales issue? You need more volume. If it is, solve that. If it's not, go on to expenses. If it's not an wasteful expense issue, then take a look at, is it about maybe inefficiencies of how you produce or how you deliver? Is it you've got too much debt? Is it that you've got some seasonality issues that you haven't planned appropriately for, or that you need to moderate that seasonality? For example, I live in Jackson, Wyoming. We have snow removal businesses. Well, they need to have something in the summertime. Summertime and spring and fall, they're going to be doing yard cleanup and landscape. In the wintertime, when everything's covered by a few feet of snow removal is what they're going to be doing to combat that seasonality. Have you overinvested in capital assets? If so, can you sell some of those capital assets? Can you convert them more productively to paying for you? I gave the example earlier on of the construction company wherein they bought 3 new trucks and tied up $250,000 in trucks. Well, they didn't need the trucks nearly as much as they needed the cash. Maybe you have excess of inventory. One of the manufacturers we work with ended up with about $3 million of excessive inventory. Extra inventory can be dangerous. It can go obsolete. It can be damaged. It has to be stored and insured and protected. You got to be careful about that. And then finally, and this is one that most people don't think about, is it fast growth? Growth sucks up capital. If I've got a business that historically has grown at 5 or 6%, and then we start working with them, and now all of a sudden they start growing at 17%, 37%, which is not uncommon, they have to make sure they plan through their cash flow, because if they've always grown at a slow 5, 6%, and then all of a sudden they start going at 17 or 37% growth, they're going to need to have the cash flow to fund that growth until the incoming receivables, collected dollars, can catch up with the cost of that growth part. So that was what I wanted to cover today. But I told you in an earlier podcast that we gave you an email. And so some of you have been sending in questions, and I want to say thank you for that. If you want to send in a question each week, I'm going to be choosing 1 or 2 of them to answer here. I'm going to be doing the one today about how can we get more from our remote team member admins or executive assistants. I'm going to talk about that in a moment. But please send them to thebusinesscoach@mauimastermind.com. thebusinesscoach@mauimastermind.com. This question set came from, actually it was a client of ours of all people. And the question was, David, what do you think about VAs or remote admins? And so, how do you think about an assistant? Now, I've been leveraging a personal assistant now and an executive assistant now for 27 years and counting. And I've had great successes with it, and I've had a few tough moments with that. Generally, for me, if I would have gone backwards at the very beginning, I liked having somebody there local for the whole part. What I've subsequently discovered after, 15-ish years in Jackson Hole with a very tight transitioning labor market, it's hard. People leave. It's hard to keep someone good for a long period of time. I've bifurcated the role. There's some of the things as an assistant that you need to be here physically for me to do. Setting up the studio before I come in to do my podcast, since no one else is out here in Jackson, having my assistant set it all for me. That's an example. So I can come in and save 20, 30 minutes when I come in to do a recording like this. Or taking, if I have some things that need to be sent overnight express or certified, getting to the post office to handle that. Those are things that require a physical person. But what I discovered was where I need probably about 1.5 people of assistant support, I found for me that I probably only need a third of a person, so to speak, 20-ish hours or 15 hours per week of that help locally for those types of things. And the rest of it can be done remotely, which is what I've got. We've done remote businesses for 20 plus years, so we were already very comfortable with that, but it never occurred to me. Now technology has gotten so much better where someone can go in on my Outlook account and process my inbox of email, can make sure my calendar is done the right way, can deal with things like password management for me, other parts for my non-critical password stuff. There's whole bunches of things an assistant can do travel-wise for me, right? So I love having remote people to do that. Now those remote people can be US-based or they can be overseas. All of that's fine. I've had great successes both ways with that. So, and I'll look at clients that we've coached. The bigger thing is not overseas versus domestic. The bigger question is, A, have you clearly gotten to know what you need the person to do, and what type of person do you need to find to be great at it for you? Defining out the role and what your need is and hiring for the must-haves is more important than whether it's foreign or domestic with that part. Yes, you get the cost savings of going overseas, but that's not the biggest driver. You're looking for a quality person. Because whether you're paying, $7 an hour, $6 an hour to $36 an hour, if you're generating $500 an hour of profit for your business, or $1,000 of profit per hour for your business, it's incomparable or inconsequential, the two. What matters is, does this person truly make you better? Does this person truly save you time? Does this person truly leverage you? So I'll share 3 quick more ideas with that. Number 1, ticklering of information. I remember 20 years ago, I'd go on a business trip, and Judy, my then assistant, would hand me a manila folder that had all the information for that trip. Or if I had appointments set up, meetings for that day, she would have set up for me folders that had all the information I need for those meetings. Nowadays, I just double-click on the appointment, and Kazel has right in the appointment memo our past email correspondence that deals with the meeting, directions if I'm going to physically go there. Maybe it has a spreadsheet that was sent that I should review. Everything is stored right there, so date and time-specific information is stored on my calendar, and my assistant can put that all there if I train him or there. Number 2 tip for you, especially if you use Microsoft Outlook, there's a function called Quick Steps. Quick Steps. And Quick Steps inside of Outlook is one of my favorite ways to make myself more effective working with my assistant. So Quick Step is a way that if I have an email where the cursor's on it and I click a Quick Step, it takes and it creates a rule-based thing I want it to do. For example, one of the rules I have here is I have a Quick Step that says assistant, I have to abbreviate it, keep it small, assistant do. So if I click on assistant do with that email, it categorizes it so that my assistant knows that she's supposed to do it. So it categorizes it, and it moves it into the action folder. So that's an example of a quick step. So I can go through my inbox, and if she's missed something that I want her to handle, I just click on Assistant Do, and the quick steps, it's part of the ribbon at the top there of the Outlook. And in my case, I've set it up to categorize it as Assistant Do and to put it in the action folder. Another one I have is Assistant Add to Appointment. Very common one for me, that information comes in and I want her to put it to the appointment memo. Now here's the advantage of quick steps. Number 1, it's faster. Number 2, it trains your assistant about how you want him or her to handle your inbox, such that over the course of 30 days, 60 days, and 90 days, they're going to learn that they're going to catch this stuff now. Oh, this type of information David wants me to handle. Oh, this type of information David wants me to put it to the appointment memo. Oh, this type of information David wants me to unsubscribe him from the e-letter. You can do that through quick steps. It makes it faster for you to process your inbox, but it does it in such a way, if you set it up properly, that you're training your assistant how to be more effective with that. The final kind of tip that I'll share with you is don't go slow here. Here's what I mean by that. Some people are afraid to hire an assistant, and they say to themselves, well, I don't know if I'd have enough for them to do. Or I would keep me too busy trying to keep them full. So if you've got an assistant, let's say you're paying them $8 or $38 or somewhere in between, and you're able to earn $500 per hour of actual profit, why would you be concerned if they save you even 5 hours in a week and you have 40 hours that you pay them? So there's a gross inefficiency there. From a pure financial math standpoint, you make a lot more money with that extra 5 hours they're saving you that week. Don't worry if they have empty time. I will often tell a brand new assistant saying, hey, until you're up to speed, some of the things that you do are going to be less value. And you might even have some empty moments in there. And if you do, it is what it is. Until you get up to speed, there's some things I can't hand off to you yet. It might take you 60 or 90 days before you're ready for me to hand them off. And it doesn't make sense for me to stress out in giving you stuff to do when I have other higher value things to do. So we're just going to accept that for the first 30, 60, 90 days till you get up to speed, there's going to be some inefficiencies. And to that end, I actually have some extra projects that are more cumbersome, longer projects, scanning of documents or going through past systems of things that I can use that would be valuable, but not really that great value, but it doesn't take a lot of my time, transcription work, etc. So there you have some ideas about how to better leverage your assistant. Thank you for being part of this episode of The Business Coach. I hope you got some good ideas, how to diagnose a cash flow challenge, and quite frankly, how to leverage an assistant better. I wish you the very best of luck. And until next week, bye-bye.